$11 billion. That is how much money vanished from the balance sheets of what was once America's second-largest telecommunications company. Not through some sophisticated offshore scheme, not through a web of shell corporations buried in the Cayman Islands, but through a bookkeeping trick so elementary that any first-year accounting student could have spotted it in under 10 minutes. WorldCom, a company that, at its peak, was valued at $186 billion, a corporation that employed tens of thousands of Americans and carried the phone calls and internet traffic of millions more, had been building its empire on numbers that simply were not real. Pension funds, retirement accounts, university endowments, ordinary Americans who bought the stock because every analyst on Wall Street said it was solid. They all trusted the numbers. The numbers were a lie. And by the time the truth surfaced, investors had lost more than $180 billion in the largest accounting fraud in American history, a fraud so massive it made Enron look like a warm-up act. To understand how this happened, you have to go back to a time when long-distance phone calls were big business. The late 1990s, the Internet is exploding. Telecommunications is the hottest sector on Wall Street. And at the center of it all stands a man named Bernard Ebbers, a former basketball coach and motel owner from Edmonton, Alberta, who somehow talked his way into founding a tiny Mississippi company called Long Distance Discount Services in 1983. Within a decade, through relentless acquisition after relentless acquisition, Ebbers transformed that small-town startup into WorldCom, a telecom giant that merged with MCI in 1997 and became the second most powerful name in American communications, right behind AT&T. Wall Street loved him. Analysts loved him. The stock price kept climbing, and nobody asked too many questions. The board of directors approved virtually everything Ebbers proposed, sometimes without formal meetings, sometimes without supporting documents, sometimes with little more than a phone call. They approved over $400 million in personal loans to their own CEO, money Ebbers needed to avoid selling his WorldCom shares and triggering a stock crash. $400 million in loans to one man from the company he ran, approved by the board he controlled. And the firm responsible for auditing all of this, for making sure the books were clean and the numbers were honest, was Arthur Andersen, the same accounting giant that had just finished failing to catch the fraud at Enron. The stage was set, the controls were gone, and the man holding the pen was about to start rewriting reality. Here is how the fraud actually worked, and the simplicity of it is what makes it so disturbing. Every quarter, WorldCom paid enormous fees to other telecom companies for the right to use their networks to carry calls. These are called line costs, and they were WorldCom's single largest expense, billions of dollars flowing out every year just to. In accounting, these payments are what is known as operating expenses, the everyday cost of running a business, no different from a restaurant paying its monthly electric bill or a trucking company buying diesel fuel. Operating expenses hit your income statement immediately. They reduce your reported profit that quarter. They are routine, unglamorous, and unavoidable. But there is another category in accounting called capital expenditures. These are long-term investments, things like buying new equipment, constructing a building, or laying fiber optic cable. Capital expenditures do not hit your income statement all at once. Instead, they are spread out over years through a process called depreciation. And that distinction, that gap between an expense you report now and an investment you spread over time, is the crack through which $11 billion disappeared. Think of it this way. Imagine you own a small business and every month you pay $2,000 in rent. That is an operating expense. It comes straight out of your profit. But one day you decide to tell your accountant to record that rent payment as if you had purchased the building itself. Suddenly, instead of losing $2,000 this month, your books show you acquired a valuable asset. Your profit looks higher. Your business looks healthier. And anyone reading your financial statements would think you are doing better than you actually are. That is exactly what WorldCom did, except they did it with billions. Under the direction of Chief Financial Officer Scott Sullivan, WorldCom's accounting team took those massive line cost payments, ordinary operating expenses that should have reduced quarterly earnings, and reclassified them as capital expenditures. Quarter after quarter, billions in real costs were quietly moved from one column to another through simple journal entries. The target was precise. Sullivan wanted reported line costs to stay at exactly 42% of revenue. The real number was consistently above 50%. The difference between those two figures was the size of the lie. And with every fraudulent entry, WorldCom reported profits where there were actually losses, growth where there was actually decline, and strength where there was actually a company bleeding out from the inside. This was not a victimless accounting exercise. Here is why this matters to you as an American. WorldCom's fabricated cost structure did not just fool investors. It warped the entire telecommunications market. Imagine you are running AT&T or Sprint in 2001, bidding against WorldCom for a major government contract. You price your bid honestly, covering your real costs plus a reasonable margin. But WorldCom bids lower, impossibly lower, because their reported costs are fiction. You lose the contract, you cut staff, you slash budgets. AT&T's own vice chairman later admitted that his company spent years trying to figure out how WorldCom's numbers were even possible, dissecting every public filing, scratching their heads, never realizing the answer was simple. The numbers were fake. Across the entire telecom industry, more than 300,000 workers lost their jobs as honest companies tried to compete against a phantom. Those were real families, real mortgages, real college funds that evaporated because one company decided the rules of accounting did not apply to them. And through it all, the scheme fed on itself. Fake profits kept the stock price high. A high stock price allowed WorldCom to keep acquiring other companies with its inflated shares. More acquisitions meant more complexity, more places to hide the fraud, and more reasons for analysts to keep believing the growth story. Bernard Ebbers, whose personal fortune was tied almost entirely to WorldCom stock, needed the price to stay up. The board needed the price to stay up. Sullivan kept the entries flowing. In 1999, WorldCom even attempted to merge with Sprint, a deal that would have created the largest telecom company on Earth. The Department of Justice blocked it. And that rejection was the first crack in the foundation, because without a new acquisition to absorb, without a fresh balance sheet to fold into the fiction, the internal numbers began to strain under their own weight. The stock started falling. Analysts started asking harder questions. And by early 2002, WorldCom's credit rating had been downgraded to junk status. But the books, the official, audited, publicly filed books, still said everything was fine. The first person to say no was not a federal agent, not an SEC investigator, not a Wall Street analyst with a sudden crisis of conscience. It was a budget analyst in Mississippi named Kim Imai. Hired by WorldCom in 1996, Imai had spent years watching things that did not add up. Suspicious relationships between executives and the vendors they awarded contracts to, contractors being paid rates that made no business sense, cost-cutting directives that crossed the line from aggressive to improper. But in late 2000, Imai was asked to do something he believed was not just questionable, but outright illegal. He was instructed to reclassify labor expenses in WorldCom's Network Systems division, moving them from operating costs to capital expenditures. The purpose was unmistakable, to make the company's bottom line look profitable when it was not. Imai refused. He reported the order to the chief operating officer. The directive was halted before it could be carried out. And shortly after, Kimimag was fired. The man who said no lost his job. The people who said yes kept theirs. And the fraud continued, growing larger with every passing quarter, because the one person willing to speak up had been quietly removed from the building. But what the architects of this fraud did not know, what Scott Sullivan and Bernard Ebbers could not have anticipated, was that deep inside WorldCom's own internal audit department, a woman named Cynthia Cooper was about to start asking questions that would bring the entire empire down. Cooper was the vice president of internal audit, and in the spring of 2002, her team began noticing irregularities in WorldCom's financial records, transfers that did not have proper documentation, entries that did not follow generally accepted accounting principles, numbers that simply did not reconcile. She assigned one of her auditors, a man named Gene Morse, to dig deeper. And what Morse found, working alone at night to avoid detection, downloading massive files when the company's servers were quiet and no one was watching, was the loose thread that would unravel everything. Morse discovered a single entry for $500 million in computer expenses that had been logged as a capital expenditure. There was no authorization for it. There was no supporting documentation. There was no business justification of any kind. $500 million recorded as an investment in company assets with absolutely nothing behind it. Then he found another $2 billion in unauthorized capital spending. Then Cooper's team identified 49 separate prepaid capacity entries totaling $3.8 billion in fraudulent transfers across 2001 and the first quarter of 2002. When they ran the real numbers, the picture was devastating. WorldCom's reported profit of $130 million in the first quarter of 2002 was not a profit at all. It was a loss of $395 million. The company was not growing. It was dying. And every quarterly report that had been filed with the Securities and Exchange Commission had been a fabrication. Cooper took her findings to CFO Scott Sullivan. Sullivan's response was to ask her to delay the audit until after the third quarter. She refused. Sullivan then attempted to justify the entries by invoking something called the matching principle, an accounting concept that allows costs to be recorded in alignment with the future benefits they are expected to generate. He argued that WorldCom had invested heavily in network expansion during the late 90s, anticipating a surge in customer usage that never materialized, and that the reclassifications were a legitimate exercise in professional judgment. The audit committee gave him until Monday to produce supporting documentation. Monday came. The documentation did not. Because it did not exist. It had never existed. There was no economic rationale, no GAAP justification, no defensible logic behind any of it. The entries were not a matter of interpretation. They were fiction. On June 25, 2002, WorldCom publicly announced that it intended to restate its financial statements by $3.8 billion. The stock, already battered, collapsed completely. Scott Sullivan was fired. 3 days later, 17,000 WorldCom employees, people who had nothing to do with the fraud, who showed up to work every day believing they were part of a legitimate company, lost their jobs in a single round of layoffs. On July 21st, WorldCom filed for Chapter 11 bankruptcy protection, listing $107 billion in assets and $41 billion in debt. It was, at that moment, the largest bankruptcy filing in American history. The SEC filed civil fraud charges, the FBI opened a criminal investigation, and Cynthia Cooper, the woman who refused to look the other way, who refused to delay her audit, who refused to accept that $500 million could simply appear on a balance sheet with no explanation, became one of 3 whistleblowers named Time Magazine's Persons of the Year for 2002. Now, here is something every American investor should know, because this is not just a story about one company. If you own stocks, if you have a retirement account, If you have ever trusted a quarterly earnings report to make a financial decision, there are tools available to you right now that can help you spot the warning signs before it is too late. The SEC's online database, called EDGAR, allows anyone to look up the actual financial filings of any publicly traded company for free. One of the clearest red flags is when a company reports strong earnings growth, but its actual cash flow tells a different story. If profits are rising on paper but cash is not flowing in, something may be wrong with how those profits are being calculated. You can also use FINRA Broker Check, a free service that lets you verify the background of any broker or financial advisor. These tools existed before WorldCom. They exist today. The difference is whether people use them. The legal consequences came swiftly, though not equally. Bernard Ebbers, the man who had built WorldCom from a Mississippi storefront into a telecommunications colossus, was found guilty of fraud, conspiracy, and filing false documents with federal regulators on July 13, 2005. He was sentenced to 25 years in federal prison. His defense team argued that Ebbers was a big-picture CEO who left the accounting details to his CFO, that he did not understand the mechanics of the fraud, that Sullivan had acted independently. The jury did not believe it. Scott Sullivan, the man who had designed and executed the reclassification scheme, cooperated with federal prosecutors and testified against Ebbers in exchange for a reduced sentence. He received 5 years. Comptroller David Myers, Accounting Director Buford Yates, and senior accountants Betty Vinson and Troy Normand all pleaded guilty to conspiracy and fraud charges and received lesser sentences. Vinson, who had carried out Sullivan's journal entries despite knowing they were wrong, told the court she had been afraid of losing her job. She was sentenced to 5 months in prison and 5 months of house. Arthur Andersen, the firm that was supposed to catch all of this, the same firm that had already failed to detect the fraud at Enron, did not survive the fallout. The accounting giant, once one of the most respected names in the profession, collapsed entirely in 2002, taking with it the jobs of tens of thousands of auditors and consultants. The money trail told its own grim story. The SEC reached a settlement requiring WorldCom to pay $750 million to compensate investors, with the total corporate settlement eventually reaching $2.25 billion. J.P. Morgan Chase, which had helped sell $5 billion in WorldCom bonds, paid $2 billion to settle. Citigroup paid $2.65 billion. Arthur Andersen paid $65 million. But those numbers, as large as they sound, were fractions of what was. Investors, many of them ordinary Americans with retirement accounts and pension funds, lost more than $180 billion in total. And for the 17,000 employees who were laid off the week the fraud was announced, the AFL-CIO stepped in and negotiated a severance payment of $5,000 each, while the company's newly appointed CEO was offered a compensation package worth $20 million over 3 years. $5,000 for the people who lost everything, $20 million for the person hired to clean up the mess. In the wake of WorldCom and Enron, Congress passed the Sarbanes-Oxley Act of 2002, the most sweeping reform of corporate governance since the Securities Act of 1933. The law made CEOs and CFOs personally liable for the accuracy of their company's financial statements. It created the Public Company Accounting Oversight Board to regulate auditors. It strengthened protections for whistleblowers, and for a time, it seemed like the system had learned its lesson. But the uncomfortable truth is that the fundamental tension at the heart of this story has never been fully resolved. The companies being audited still pay the firms that audit them. The incentive to keep clients happy still exists. Corporate fraud did not end with WorldCom. Wirecard, a German payments company, fabricated 1.9 billion euros in cash that did not exist. Luckin Coffee, a Chinese chain listed on American exchanges, invented hundreds of millions in revenue. FTX, a cryptocurrency exchange trusted by millions of investors, turned out to be a house of cards built on customer funds. The mechanisms evolve, the technology changes, but the underlying architecture of deception, the gap between what the numbers say and what the numbers mean, remains. And that brings us to the question that this story leaves behind, the one that has no comfortable answer. If Cynthia Cooper had listened to Scott Sullivan, if she had agreed to delay her audit by just 1 quarter, if she had decided that it was not worth the risk to her career, to her safety, to her reputation, how much longer would this fraud have continued? How many more billions would have been stolen from American investors before anyone noticed? The system that was supposed to protect us, the auditors, the regulators, the board of directors, the credit rating agencies, every single one of them. The only thing that stood between the American public and an even larger catastrophe was one woman who refused to stop asking questions. WorldCom began as a small-town dream in Mississippi built by a man who believed that ambition could outrun arithmetic. For a while it did, but arithmetic always wins. And somewhere tonight, in a boardroom you will never see, in a spreadsheet you will never read, someone is making the same bet Bernard Ebbers made, that the numbers can be made to say whatever you need them to say, as long as nobody looks too closely. The question is not whether it is happening again. The question is whether anyone is looking.